Hello everyone, this is Bert from TID Research, and in today's video I'd like to talk about the prediction market. So prediction market is getting more and more popular. Even though the TVO dropped drastically after the last US presidential election, however you can see that the hype is picking up again. And that is mostly due to that the more and more jurisdictions start to legalize this kind of prediction market, and also because media also start to cite the statistic and also the probability from, for example, PolyMarket more and more often as one of their data sources. On top of that, we're also seeing that in addition to PolyMarket, there are also more and more new prediction market. And one of the most promising out of all is the Opinion belongs to the BSC ecosystem, and then it has been endorsed and mentioned quite a few times by the YC Labs and also by Binance. So it gives the market a clear signal that the Binance thinks prediction market is pretty promising, and then also give the market a signal that the prediction market can have a lot of alpha, whether it's from airdrop or whether it's from the trading volume or whether it's from just purely placing the direction of trades. So in today's video, I would like to explain how prediction market works. And then I also like to introduce some strategies in addition to placing directional trade, how users can earn or farm from the prediction market with no delta exposure. So let's first look at how prediction market work with the PolyMarket as an example. So they are all prediction markets. However, the online mechanism is the rule of thumb is all the same. That is, the expected value of all the outcomes must be equal to 1. So you can see there are the multi-scenario market. There are also like binary market. But the mechanism or the fundamentals is the same, is that all this market, the pricing needs to be equal to 1. So you can see this is actually not an efficient market in a sense that the price of the yes and the price of no in total is more than $1. And there can be a lot of reasons for this, and this phenomenon is actually pretty common. So the common reason might be there's not enough liquidity, book is not deep enough, or there's risk premium pricing. For example, there's the smart contract risk. There's also the team reputation risk. There can also be like compliance risk. So all these factors in aggregate result in this kind of inefficient market. However, this kind of inefficiency cannot be a norm for most of the market. But theoretically speaking, the price of the yes and the price of no in total need to be equal to 1. That's for the binary market. And for the non-binary market, that is also the case. So you can see there are a lot of scenarios listed out here. How all of their expected value in combined also need to be equal to 1, theoretically speaking, and therefore the market can be efficient. Think about it from other perspective regarding the reason why it has the expected value need to be 1. So let's say right now we're in the binary market, and then we can buy yes, and then we can also buy no. So say we set up 2 wallets, and then we use one wallet to buy yes and the other wallet to buy no. So it means that no matter how the results turn out to be, both my wallet combined will get $1 because I'm going to win anyway. So it means that if I spend less than $1 to buy both the yes and no, it means that I'm going to have some risk-free profits locked in at the very beginning. So that's the reason why the yes and no, the expected value or the price combined need to be at least to 1 or larger than 1, like the market just saw, or else there's going to be an arbitrage opportunity, and then the market maker will step in to place their orders. So that's the fundamental mechanism about how prediction market works. And let's look at how markets are created and how all this, for example, price are calculated, how the online event is determined, and how the outcome of our online events can be delivered on chain and therefore resolve a market to make the loser pay the winners. PolyMarkets in essence are permissionless, so everyone can create their own markets on the dashboard. The creator of the market needs to figure out how the market is going to be resolved. Resolve means to determine the final outcome of online events. And then you have to make sure that, because PolyMarket is using the UMA optimistic oracle, you have to make sure that the online events are compatible with the UMA optimistic oracle. Resolve means that there needs to be a clear outcome of the online events, and then the outcome need to be sent to the UMA oracle and agreed by everyone else with no one against this outcome, and their UMA can send this outcome to PolyMarket and therefore determine the final results of this prediction market. So here in the rule section, you can see there is a explanation about how this market is going to be resolved. So talking about that, the market is about the exact amount of cuts of 25 basis points in 2026 by the Fed. And then the method of how they're going to resolve this market is that they're going to look at the cut that took place, not just during the FOMC meeting, but also outside of the meeting up until December 31st, 2026. And they give you some example about how they're going to calculate, how they're going to count the number of cuts. And then they also give you some example about when this market will resolve early to know, because there's some exceptional incident happens that make any cut impossible. And then lastly, it specify the resolution source of the meeting. And then it pointed out to this link. And then so everyone, before they enter into the market, they can fully understand what's the data source of this market, what kind of data source UMA is using, and therefore there's not going to be any disputes. So that is how the market can be resolved. And then you can see there's a resolver address here. Resolver address is on UMA. And then so this is going to be a smart contract. And then anyone can actually propose the market resolutions. And then the proposer can get some reward. However, the proposer will also be punished if the outcome proposed is false or disputed. So that is how the online Oracle works for PolyMarket. Lastly, we can look at how the prices are calculated. We just mentioned that the rule of thumb is that for all the expected value of all scenario combines need to be equal to 1. So the reason why that is the case is because if you look at how the initial price is determined, the order is only matched when the yes and no side of the single scenario equal to 1. For example, if you place a limit order at 0.6 for yes for a single prediction market, so there's the two scenarios where the order will be matched. First scenario is that someone sell yes order, someone sell at 0.6, or someone buy no at 0.4. That is how on market the system will consider your orders, both of your orders match. So that's the reason why we say that the yes and no in aggregate, the cost need to be equal to 1, because that is how PolyMarket calculate the price of your positions. So if you think about it, because PolyMarket, the size of the one order is always the price, because we talk about that the price is actually expected value. However, given that the price of the size of the order is always $1, you can actually think of the price as the probability. So the probability, if you think about it, like given that the size of the order is always 1, so if you think about it from another perspective, it means that for a single event, the probability of certain criteria is met is always equal to 100%. No matter if it's met or it's not met, the probability of all this scenario in total need to be equal to 100%, which makes sense and which is always true. So that is how the price on the PolyMarkets our prices on PolyMarket are calculated. So right now we understand how the prediction markets are created, how it is resolved, and also how the price are calculated. Now we can look at what are some of the exposure strategies where, in addition to placing the directional trades, you can also benefit from this hype, elevated trading volume, and then to farm with no delta neutral, with no delta exposure. So first way is very similar to how people like trading stocks, which is they calculate, they place a number of trades. They don't want to on every trade, but they want to win on the aggregate level. So in total, with the net positions, they want to win. So that is what the strategy from Jaden is about. We all know that theoretically speaking, the cost of yes and no need to be 1. However, that is also not always true on PolyMarket because there's like risk premium, there's like market volatility. This strategy focuses on the market volatility. That is when there's like a huge buying or selling demand, and then they push the price away from its equilibrium temporarily. So that is when this kind of trader would like to step in and then buy the place order when the price are distorted and deviated, and then at the end they're able to hedge away all of their positions and lock in risk-free profits. So this is their formula. They need to make sure that the cost of average and the cost of average node in total need to be less than $1. And the method they are calculating is that the total cost of all the yes orders divided by the total share of your yes positions plus the total cost of your no orders divided by total share of your no positions. This calculation will give you something called the pair cost. It means that on average, for your yes and for your no position combined, what's the cost. If it's lower than 1, it means that you're going to win because you're already locked in the risk-free APY. For online events, no matter how it turns out, because you are holding yes and you're also holding no. It means that no matter how online event turns out, the payout is going to be $1. So it means that your pair cost is less than $1. It means that you're going to win. And so this is how they're running the strategies. And then you can see there are actually 4 key metrics. The first one is that number of trade they're placing, which is here. You can see they are placing like trades. This is gap in between is the actual BTC price. And then the green one is the trade for yes position. And the red one is the trade for no position. And you can see that they're actually pretty far away from each other. It means that the price of online markets has deviated from the equilibrium price. So this is the number of trade they're placing. And then if you look at the second chart, this is the shares and the cost they spent on building these positions. And then they calculate the dollar exposure and then they calculate the share exposure. So the green one is the yes and the red one is the no. So we know the cost in total for the yes position. We also know the cost in total for the no positions. And we also know the total number of shares we have for yes and the number of shares we have for no. And you can see that the number of shares also actually need to be matched because they need to have 1 yes and also 1 no to hedge away the exposures. So after we have all these metrics, we can calculate the average cost for yes and also calculate average cost for no. And then they can see that in aggregate, the pair cost is only 0.966. So it means that for 1 yes and for 1 no combined, it only costs Jaden, the users, 0.1966. However, at the end, he can get $1. And then in aggregate, he has built around 1,200 yes plus no positions. It means that simply from doing this, he got 1,200 times 1 minus 0.966. That is his final turnout. In the last part of his article, he explained why this can work because he pointed out the most important factor, that is the emotion. In addition to the risk premium, those cannot be hedged away, but due to the market sentiment, due to the volatility, due to the momentum, due to the emotion, the price can pretty often be distorted. However, this kind of distortion will be gone like pretty soon because this kind of arbitrage may step in to place the order and therefore to take it away and lock in their profits. However, this is one of the most classic example about how people are making the market on PolyMarket, and the reason why this kind of market maker can always win because they are not betting on the direction of the online event, they are betting on the volumes. And as long as they can hedge with the delta, they are always winning. And this is one of the strategies. So this is like a quantitative approach of the strategy. And some people might be asking that I'm not as quant as this guy. And there's also other way for you to do it. So the other way is more about the information gap. So information gap can be technical or can also be pure luck. So if we're talking about the technical information gap, one of the example is the Fed fund decision. So if you are from traditional finance, you understand that there's already some kind of the Fed cut probability derived in the traditional market. And then on PolyMarket, they are also betting on this decision. So it means that if the probability on PolyMarket and the probability in the traditional financial market for a certain instruments are not the same, there is going to be arbitrage opportunities. Let's first look at how the rates are calculated, how the probability are calculated, Fed cut probability are calculated in the traditional financial market. They are using the instrument called the 30 days Fed fund futures. So if they have the 30 days Fed fund futures and then say the next cut is going to take place in 15 days later, so they can look at the Fed fund future price to figure out what's the market pricing of the next probability of the cuts of the upcoming Fed Fund FOMC meeting in the next 15 days. So that's how they're calculating it. So it means that if the PolyMarket here, the decision you're seeing here is different from the probability you're seeing here, there's going to be arbitrage opportunity. So one of the example is that for 25 basis point, no change. So it means that the Fed will hold for the next FOMC. The probability is 77%. However, if you look at the Fed watch, it means that the probability of the FOMC going to hold according to the Fed Fund futures, pricing is only 75.6%. It means that from the PolyMarket's perspective, current Fed Fund futures is underpriced. And then from the Fed Fund futures perspective, current PolyMarket pricing for no change is overpriced. Theoretically speaking, you can buy no here and then buy Fed Fund futures here. And then in the end, you can lock in your positions and have no delta, and therefore walk away with the spread in between. The actual execution can be a little bit more complicated than that, but in essence, that is how it works. So that is one of the information gap you can make use of when trading on the PolyMarket. On top of that, there's also a more straightforward way for you to leverage this kind of information gap. For example, if you attend the earnings call or earnings meeting in person, you'll realize that the earnings call online always have some few seconds of delay compared to when you really in the meeting hall listening to the chairman reporting the numbers. Theoretically speaking, you can use those few seconds to place order before the market reacts to what they hear online, for example, on a Zoom call. Therefore, you can lock in your position before everyone else and benefit from this kind of information gap. On top of that, if you like sports, you can also do something similar. And a lot of people are doing it. If you really go to the stadium, you also have like few seconds. You're also a few seconds ahead of everyone else because there's always some delay when the actual results are broadcasted online. Also, a few seconds of delays before the traders react to the what's actually happening in the stadium. So theoretically speaking, you are also able to go to the stadium in person and therefore trade before everyone else. So those are some of the strategy people are actually using to not just placing directional trade on this kind of prediction market, but they are benefiting from this kind of hype and they are trying to make market and then farm the volumes without any delta exposure.